This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. This is a finance show for small business owners about money, how it works in our business and our personal lives, and how we can build wealth to be financially independent. I'm your host, Justin Goodbread, and today is episode number 14. Now remember, we're doing a series of how to build a business to sell it. And today's episode I'm entitling, A Rising Tide Lifts All Ships. So growing up on the coast of southeast Georgia in a small town called Brunswick, Georgia, I lived in a tidal region. And those of you who don't know what tides are, it's when the ocean moves and it causes the water to move up and down over a period of time throughout the day. So you'll have a high tide and a low tide during the day. And it wasn't uncommon for me to see super high tides. They would call them a new moon tide or a blue moon tide or a blood moon tide. And there was all sorts of tides. And what it would do is it called the ocean water to rise really high, sometimes above normal, and it would cover the roads. And at the same time, when you had these super high tides, you also have the low tides, which would act an opposite. And you would look out and you would see mud in the rivers. You'd see the bottom of the rivers, sometimes just a small little stream, sometimes no stream at all, depending on how far the tide went out. And many of my adventures as a kid was centered around the marshes at low tide. I mean, we would get out and we would chase raccoons. The raccoons would get out of the trees and they would go and chase these little fiddler crabs on the ground. And we get out and chase those things. Or we would get on the edge of the bank and whenever the tide was low, we would throw out the net and try to catch shrimp. Occasionally we would take a fishing pole out, and a low tide was a good time to catch stingrays on a fishing pole or sometimes sharks in the rivers. It was just fun to get out there and stomp around the mud on low tides. But like anything, the tide would inevitably return and the rivers would begin to fill up, and the fun, we had to get out of the river else we'd get swept away. During the low tides, you would drive around the coast, and many times you would see areas of the coast where boats were sitting on the bottom of the river. Maybe the water depth during the average tide wasn't very good, but nonetheless, the boat was sitting on the bottom of the river. And when the tide rises in, it would cause the boat again to rise up and float. And hence the old saying, a rising tide lifts all ships. Now, with that in mind, think of this question. Why did you start your company? Perhaps it was freedom. Perhaps it was the pride of accomplishment. You know, you wanted to start something and get back and say, hey, I did that. But I think if we're honest, inevitably, money will eventually enter into the picture. For many people, they feel like they can earn more money working for themselves as opposed to working for someone else. And in fact, if you've heard me for any length of time, you've probably heard me say that I'm a person who will work 80 hours a week for myself as opposed to working 40 hours a week for, quote, the man. But why? Why am I like that? Well, it's entrepreneur nature, and perhaps you're the same way. Why am I willing to face risk? Why are you willing to face risk that others aren't? Why are we able to deal with high markets, the high pressure, the stress of employees, the debt, all these things? Why? Ultimately, if we're honest, it boils down to success of some sort, and many times it's measured in money. Now, here's the kicker, and perhaps a baseline for a major mistake that I see people making. Your employees are motivated by money as well. You see, as we recruit employees into our business, our desire for most of us is to build a company where the tide lifts all. I won't say ships because we don't want to talk about our employees being ships, but you understand the analogy. We're trying to build a team, a bench, if you will, like a football team or a baseball team, a strong bench that'll help us build a company where ultimately we can sell it for maximum value. That's the desire we have. We want everyone on our team to make a lot of money. In fact, the more money that our team makes, oftentimes the more money we make as the manager, as the owner of the business. And for the most part, you want your employees to just enjoy this road, this thing of business life as much as you do. But how do we do that? You see, as we approach this idea of selling a business, you may be faced with questions from your team about the role. I mean, think about it. You know, you're maybe 5 years out, 10 years out, and you're sitting there talking to your team and they realize you're getting older, or they realize the success you're having. Or maybe you're like me and you just come out and say it. Look, I'm building a business to sell at some point, folks. Maybe you're like that. Whenever you say that, it's been my experience as I consult with clients, as I consult as even myself in my own experiences, that my younger people, and I'm not going to put an age on that because I have people in their 60s who consider themselves young, have people in their 40s who consider 60 old. So it doesn't matter what the age is. But for the younger mentality folk, there's a major concern for job security. I mean, think about it. This guy's fixing to go in and sell the business? Really? What is that going to do to me? Well, I have a job. Well, on the other side of that, you have the older folks. Maybe they're financially secure and they're like, there ain't no way that I'm going through a business transition with anybody. I like my team. I like my boss. I like my company. I don't want some other corporate yahoo to come in here and tell me how to run my department or come in here and tell me how I do my job. By God, I've been doing this job for 15 years. I mean, you can understand it. So emotions run amok whenever we're talking about the sale. Even in our person as a entrepreneur who is planning on selling the business, we deal with the emotion. So I asked the question to myself, and I asked the question to many people, how can we build a team that is dedicated? How can we build a team which will help us reach the goal of selling our business one day? Well, there's a strategy, and this is where I said earlier that many times small business owners or entrepreneurs or people just getting started out, they make a mistake. The strategy they think is, you know what, in order for me to get a rising tide to make it go higher, I need to get an initiative for all the players. I need to provide them a paycheck. So whenever the team does well, they do well. Whenever the business sells, they're going to walk away with a really, really, really big paycheck. And we'll talk about the ideas there, but I have a really good friend of mine. He was an employee of a company who did just that. He joined the team with the idea of growing it over a short period of time and from a small business, under $10, $15 million business, to a business that sold for more than $300 million in a very, very short time. He was brought in to be part of this team. And when the owner recruited him to this, he said, look, we're going to share in the profits. We're going to share in the company. Your success as a team is going to be my success as the owner. My success as the owner is going to be your success as a team. And in fact, when the owner sold the business, it was a privately held company. And when the owner sold the business, he provided my friend with the biggest paycheck he's ever experienced. It was unbelievable. In fact, my friend called it, in his words, life-changing check. He's like, man, it changed my life. This is what changes legacies for family, is what he said. And in fact, my friend, whose name is Christopher Snyder, talks about this check in his book. He wrote a book called Walking to Destiny. And it deals with some of the same things we're talking about on how to prepare a company to sell. Great book. You ought to check it out. But back to where we're at. Many business owners make the mistake in the conversations when they're trying to recruit people or they're trying to get buy-in from their team for this ultimate sale. And the one mistake they do is they give away the farm. Maybe you've ever heard that. If someone says, don't give away the farm. Well, that's what business owners do. What do you mean, Justin? Yeah, you use these colloquialisms. This is old country slang. Think about it this way. If you're building a business to sell, and the goal is to build a stable bench of players to help you reach that goal, then you'll desire everyone to receive the paycheck. We've established that. More than likely, though, if you're statistically like most of the small business owners, then you want to be philanthropic. You have benevolence toward those individuals who are in the grime, in the dirt, who are pulling with you sometimes harder than we pull. And you want to do something for them. So immediately we all go in and say, let's give them ownership in the company. That's one of the quick things that people do. And I'm going to tell you that, number one, don't give ownership of your company to your employees. Don't do that. Now, hear me. You're like, dude, look, that's a huge mistake. Don't do it. Keep your equity. That's number one. Keep your equity. Now, does that mean that you're never to give any of your ownership of a company away? No, I didn't say that. But don't give ownership of your company away. Someone's once said, well, I have 51% ownership. I have majority control. No, you have majority voting control, but think about what that means. Do you really want to have your employees in the boardrooms? Do you really want to give them the financial records? Do you want to have them have tax initiatives or tax penalties? Do you want them to have phantom income or non-phantom? I mean, there's all sorts of problems whenever you have ownership. I was working with one of our clients. He's a tech guy, and he's creating a new company, and he's recruiting a high-end tech person, the very first thing he said, well, I'm going to maintain 51% of my control of my company. I'm going to give this other guy 49%. And my question was, okay, that sounds interesting. What happens if y'all don't agree after a year? The phone got quiet, and he said, well, I don't know. I said, well, are you prepared to buy him out for the other 49% at an unknown value in the future? Or are you prepared to put on today in writing what you think that value will be and that y'all can agree to it? And the phone got quiet again. He said, man, I never thought about that. So number one, if you're trying to be benevolent, if you're trying to create a good paycheck for somebody in the future when the company sells, you don't have to give ownership of the company away. You don't. So go ahead and scrub that from your mind. Number two, you want to give the different divisions of your company, the different sectors of the company, your executives, your rank and file, your managers, however your organizational chart, you want to give your team members all the way down to the janitor the ability and the right to earn money based on the success of the company. Perhaps the most common form that I see is a stock option. That's probably the most common form. We're going to come back to that in a second. A stock option is one. So you want everybody incentivized, if you will, and pulling in the same direction as you are in order to have the success of the company. I think I've used this analogy before in some of the old podcasts, but I remember one day on a mule day in South Georgia, I was at a friend of mine, my dad, my brother, and I were there, and this guy had a mule, and he had a single horse mule hooked up to a plow. The mule was doing good. It was pulling the plow just fine, but then he was teaching us a lesson to us young agrarians out there, just kind of watching how this old timers used to plow. And he took that mule and he hooked it up to a slightly bigger plow. And I don't remember the weight. I think the bigger plow was like 4 times the weight of the small plow. And there was no way in God's green earth that mule was going to pull that bigger plow. But then he did something. He put another mule beside it. Now, mathematically, it didn't make sense, to me at least. You had a mule pulling, I'm going to make a number up, like a 150-pound plow, and it pulled it just fine through the dirt. Plus, he had the man sitting on the back in this particular plow. And now he's moving it to like a 700-pound plow with the same man on the back. Well, you would think that if one mule can pull 150, then 2 mules could pull 300. It wasn't the case. 2 mules pulling the same direction was able to pull almost 4 times that of a single mule. It was unbelievable to me. And forever impacted my business knowledge. And that's what we're trying to do with the incentives for every person in your company to be able to make money. You want everybody on the team pulling their weight. Because if you get everybody pointing in the same direction, holy cow, watch out, Batman. You guys are going places.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
Let's go to number 3. Take care of your leaders. The people who are making it happen. When the time comes to sell the company, hear me out here, the buyer will request the tenure and commitment of your management or executive team. So what do I mean by that? Let's say you're selling the company and the buyer says, hey, look, we want to have a consulting agreement with you, the owner of the company, for 12 months or 18 or 24, 36 months. But during the same time period, we want your executive team there as well. Now, think about it. If what stands between you and a big behind paycheck one day is your current leadership team, then you want to take care of them now. You want to make sure that you have contingencies in place to show that your executive team is committed to the success of the company and to the disposition of the purchase of the company. The buyer's going to want it anyways, more than likely. I've seen many companies allocate 10 to 20% of the company's stock just to the management team. And whenever that happens, the buyers feel more comfortable knowing that the executive team has a stake in the long-term success of the company. So you've got to take care of your leaders. Now, I know point number 1, I said don't give away the farm. Don't give them stock. Your leaders may be a slightly different scenario. But if you have 100 shares, you're only talking 10 shares to the entire committee. You don't have to give up 51% or 49% of the company. You don't have to do that. Here's the 4th thing you can look at. It's been said, and I forget where I heard this, that we are to reward the actions that we want to encourage. You know, if someone does something very good, you want to reward it and you want to be as public about it. You should be greedy with your company stock, though. Just because you have, and I'm not trying to degrade employees by no means, but just because you have a rank and file employee that did an outstanding job one time doesn't mean you go and give them stock in your company. Come on, people. We're not here to throw the stock around just because we have the power. Think about it. Like I mentioned earlier, do you really want a bunch of your employees acting as shareholders, sitting in the meetings? No. However, you want to use your company stock, your future sales revenue, bonuses, as means of rewarding the attributes you want to build upon. That's where we're headed. So how do you reward employees? If we're not going to give everybody a share of stock, how do we reward them? Well, we can be benevolent, but we can also be fair. So here's a few ways. Perhaps the most popular way to do it is what's called a stock option plan. Now, I could spend episodes, weeks on tactics on how you put together stock option plans, but that's not my intent for today. Today, I just want to introduce the idea and give you a very, very high level. Okay. I'll tell you right now, if you want to entertain the idea of a stock option plan or stock options for your company, you're going to have a competent attorney and a powerhouse accountant on your team. There is so much red tape, legalese, laws, and they are changing every day. You're going to need a good consulting team. But let's give a simple explanation as to what a stock option plan is. So basically, you're providing your employees a yearly option to buy stock in your company. Notice I didn't say you're giving your employees stock in your company. I didn't say that. I said you're providing them the option to purchase stock in the company. So at the same time, you're controlling the amount of stock that's eligible to be purchased, you're setting the stock price, and you're providing vesting terms. So let's deal with those. So the amount of stock. You can decide the number of options you want to give each employee. Again, notice I didn't say stock. You're not deciding to give stock away. You're giving them the right to buy stock from you. The employee is going to have to purchase the stock. You're just giving them the right to buy it. Thus, when they buy the stock, they're investing in the long-term success of your company. The Bible, for example, it even talks about this. It says, where your treasure is, there will your heart be also. Think about it. If you can get your employees to invest the money that they earn in their paychecks into the company, the very company in which they work for, then holy cow, hold the horses. You have a committed employee. You have someone who says, I see value in this company and I'm putting my dollars to work in this organization. So here's how this works in a nutshell. Let's say that you've given your employee the right to buy the stock. Now you place a purchase price on the stock, typically at a fixed price. Let's say you give the employee the right to purchase 10 shares of stock at $1,000 a share. Thus, if the employee were to purchase all 10 shares, they would pay $10,000. And you've given them the option to purchase the stock for a period of time. Commonly, it's 5, 6, 10, 15-year period of time. So if in the course of 10 years, let's say the company's value triples, and the employee can now purchase a stock that's now is tripled in value. It was $1,000, now it's $3,000 in value, but they can go in and purchase it for $1,000 a share. All of a sudden, that $10,000 purchase is worth $30,000. That's how this works. So you're giving them the right to buy the share, so they're investing in the company. Now, the third thing that you can control is the vesting. So just because you give your employee option to purchase a stock doesn't mean they can what's called exercise that option or go out and buy the stock day one. No. We're going to hold that a little bit. This is kind of like, in my world, I use the term golden handcuffs. You can require that employee to stay with the company a length of time before they're able to use the option, before they're able to actually buy the stock. So I could go into an employee and say, hey, look, I'm going to give you the right to buy 10 shares of my company at this price, whatever the price is, but you're not going to be able to do that for another 5 years. And so now you've incentivized that employee to help you grow the company over that period of time. And there's what you have, a stock option plan. Now, that particular method is where you're actually giving up stock in the company. What happens if you don't want to give up stock in the company? Well, there's another way, and some people call it phantom stock. The way it's referred to in the professional circle is stock appreciation rights or units. A unit is typically with an LLC or some other entity of that nature. Basically, in this format, you're providing money to the employee without ownership or control. Okay. I currently have this as part of one of my structures in my corporation. I own 100% of the stock of my corporation. Actually, it's an LLC, so it's the units of my corporation. I own 100% of those, but I have key employees to which I provide a bonus structure as the company does well and as they do well. if I sell the company in a period of time, the employees will be incentivized per their respective phantom ownership. And that kind of keeps the employees from getting up in my business, so to speak. And I don't mean that in a bad way, but really, do you want employees in your boardrooms with you? I mean, do you really want them hearing confidential information? Most of us don't. Most of us do not want our employees hearing confidential information. Now, look, again, I'm giving you a high level. There are many regulations involved whenever you're dealing with employees, especially employee income, ownership, rights, warrants, taxes. Holy cow. Taxes are going to play a major role. Law is going to play a major role. You are going to need the help. No if, no and. You are going to need the help of a competent attorney who specializes in this type of work if you're going down this road. And you're going to have a powerhouse CPA. You're going to have an accounting firm which can deal with this. This area of planning is tricky, primarily because the people who write the rules keep changing the rules, and it's frustrating for us planners whenever we're dealing with this. So look, one point I want to add before we finish up this episode today is if you're considering this, don't just go in and just say, hey, look, employees, I'm going to do this. If you plan to enrich your team, then you're going to need to invest some education into your team. You want your employees to be enriched, but you want them to be well educated on how this is going to enrich them. You don't just want to offer your employees the ability to earn stock and them not really understand the value or the golden nugget they really have. You want to act in fairness to all employees. You want to give everybody the ability to grow with the company. So guys, look, today I just want to provide you a tasting of how you can help your employees catch the vision, if you will. I want to give you an idea on how you can build a team, how you can recruit a team and carry your company to the next level. My friend Chris, he was part of it. He experienced it. I love his story. It's a great story. Perhaps you know somebody like that. Bottom line is, if you design the benefit plan to your team correctly, you will build a superstar team that will stay committed to you and your company and will reap the reward of the rising tide. The rising tide will lift all of the ship's income in this scenario. So guys, that's it for episode 14. It's been fun. I love this stuff. I hope you're enjoying it. If you are, shoot me a message. Drop me a line here somewhere. Let me know if I'm confused you or something. I'm having a blast with this. I look forward to continue this series with you. Hey, look, like I always say, life is hard, life is fun, life is complicated, and employees, they can be the life or death of us. Money doesn't have to be. Let's continue to make our lives at least financially simple. Y'all go out and make it a great day.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.